Liam buys a single-family investment property. Noah puts the exact same money into a broad market index fund. Both are convinced they made the superior choice. Both are wrong, because one forgot to count the hours and the other forgot to count the zeros. When you run the complete mathematical breakdown over 20 years, the actual gap will make your stomach drop. Let's make this an exact side-by-side comparison. Liam and Noah both have $60,000 saved. They both earn $65,000 a year. Same age, same city, same financial starting line. The only difference is what happens to that initial $60,000. Liam uses his $60,000 as a 20% down payment on a $300,000 suburban single-family home. He locks in a 30-year fixed mortgage at 6.8% interest. Between principal, interest, property taxes, and insurance, his monthly baseline cost is roughly $2,050. He puts the home up for rent and finds a tenant willing to pay $2,550 a month. On paper, that looks like $500 a month in clean cash flow, $6,000 a year, before spending $1 on maintenance. Liam feels like a financial genius. Noah takes his $60,000 and drops it straight into a low-cost broad market index fund. No mortgage, no tenant, no keys. He sets up an automated monthly recurring investment of $400 and goes on with his life. When his coworkers ask where he puts his money, he says index funds. They nod politely and switch topics. Nobody is impressed. On day one, Liam has a deed, a tenant, and a great story for dinner parties. Noah has a brokerage account and a confirmation email. In terms of social status, it isn't even close. But emotional satisfaction and mathematics are two very different things. For the first few years, Liam lives the landlord dream. Rent checks land on the first of every month like clockwork. He drives by the house on his weekend errands thinking, I own that. He claims tax depreciation and mortgage interest deduction, saving thousands on his tax return. He's building equity with every monthly payment and watching neighborhood home values tick up. It feels tangible, real, and lucrative. Noah logs into his brokerage account once a quarter. Up a little, down a little, up a bit more. Year one, his $60,000 turns into $66,000. Year two, maybe $73,000. It feels completely static. There's no physical asset to look at, no tenant texting him, just digits on a screen. Liam's friends ask him for real estate tips. Nobody asks Noah about anything. By year three, let's look at the actual numbers. Liam has collected roughly $91,800 in total rent payments. His total mortgage and escrow payments equal about $73,800. That leaves $18,000 in gross margin. Sounds strong until you subtract real-world property costs. Over 3 years, he replaced a cracked main plumbing pipe for $3,200. He swapped a blown HVAC compressor motor for $1,900. He endured 1 month of vacancy between tenants, costing him $2,550 in missed rent, plus $700 to clean, repaint, and list a unit. Liam handles property management himself to save cash, which means taking calls at 10 p.m., scheduling contractors during his workday, and running tenant screenings on weekends. After all true expenses, Liam's actual net cash flow over 3 years lands around $2,500 to $4,500, not the $18,000 that looks so convincing on paper. And that doesn't account for a single hour of his personal labor. Noah, meanwhile, invested his $60,000 initial sum plus $14,400 in monthly contributions. At a standard 10% annual return, his $6,000 net worth grew to $93,000. He spent 0 hours managing it, 0 time making calls, 0 effort dealing with emergencies. However, Liam has one major factor working in his favor: leverage. His $300,000 house appreciated by roughly 3.5% per year, putting its market value at around $333,000. His remaining mortgage balance sits around $232,000. That gives him roughly $101,000 in equity. That wealth build came from controlling a large asset with bank financing, an advantage stock investors cannot replicate without taking on dangerous margin debt. The monthly rent collection is a number everyone highlights on social media. What rarely gets mentioned is everything that chips away at that check before you keep a single cent. Vacancy rates. The national average rental sits empty about 1 month out of every 12 to 18 months. That is a full month of zero income while the full mortgage payment remains due. Maintenance and repairs. The standard benchmark is setting aside 1 to 2% of the home's total value annually for upkeep. On a $300,000 property, that's $3,000 to $6,000 every year. Capital expenditures.
Roofs, water heaters, and HVAC systems have defined lifespans. These are fixed future liabilities coming in non-negotiable blocks of $4,000 to $12,000. Management costs. Hiring a property manager takes 8 to 10% of monthly rent, $200 to $250 per month. Doing it yourself means working an unpaid second job. Non-paying tenant risk. A tenant who stops paying rent and forces legal eviction can cost 3 to 6 months of lost revenue, plus legal fees, wiping out years of accrued profit in a single stretch. By year 5, Liam understands the true work of property ownership. He's on his third tenant. He had to repair a roof section for $7,500, and his property taxes and insurance rates rose significantly. He raised rent to $2,750, which helps, but his actual cash-on-cash return hovers around 4 to 5% after all real expenses. Noah hasn't altered his routine. By year 7, his portfolio has grown quietly from $60,000 to roughly $165,000 to $175,000 with his steady $400 monthly deposits. He didn't pick individual stocks or time the market. Compounding interest is beginning to accelerate, where annual portfolio gains now generate more fresh returns each year than his original contributions. By year 10, Liam's property worth roughly $420,000. Remaining mortgage is about $200,000. His home equity sits around $220,000. However, subtracting every out-of-pocket expense over a decade, repairs, CapEx, upgrades, insurance spikes, vacancies, Liam paid an extra $25,000 to $40,000 beyond his starting down payment to keep the property operating. Noah's portfolio sitting at roughly $215,000 to $230,000 through consistent $400 monthly deposits and average 10% returns. Total capital invested, $60,000 starting cash plus $48,000 in monthly deposits equals $108,000 out of pocket. The remaining $115,000 plus is pure cumulative gain without working a single weekend. At year 10, their total net worth figures look remarkably close. Liam holds a minor advantage due to initial leverage, but he took on hundreds of thousands in personal debt, concentrated his wealth into a single property in one zip code, and logged hundreds of hours of manual effort. Noah spread his risk across thousands of global corporations and never lost a night of sleep. By year 20, the difference in execution becomes fully visible. Liam's real estate position. Property market value $580,000 to $620,000. Remaining mortgage nearly fully paid off. Total equity approximately $520,000 to $580,000. Cumulative net rental cash flow after 20 years of maintenance, unit turnovers, roof updates, taxes, and repairs, roughly $60,000 to $90,000 total net gain over expenses. Noah's stock market position. Portfolio value at 10% average returns, $400 a month contributions, $580,000 to $630,000. Total out-of-pocket capital invested, $156,000. $60,000 original plus $96,000 monthly contributions. Total pure compounding returns, $430,000 plus. When evaluating total net worth, both end up in the exact same ballpark, roughly $600,000. The fundamental difference lies in how they reached it. Liam worked for his wealth through active labor, debt liability, and illiquid risk concentration. Noah automated his wealth through patience, market liquidity, and passive growth. Here is the key detail that tells the mathematical scale. If Noah managed to increase his monthly contribution by just $200, investing $600 a month instead of $400, his 20-year stock portfolio jumps to roughly $760,000 to $800,000. In the stock market, scaling up your investment simply means increasing an automated bank transfer. In real estate, scaling up your returns usually means buying property too, securing another loan, risking another down payment, and doubling your physical labor load. Ignoring the drawbacks of stock investing would be dishonest. Index funds carry distinct risks, brutal short-term volatility. Market drops are mentally painful. In 2008, the market fell roughly 37%. In early 2020, it plummeted over 30% in weeks. Watching a $200,000 portfolio drop to $130,000 in a month tests your discipline. Millions of retail investors panic sell at market bottoms, locking in massive losses. Zero native leverage. You cannot walk into a bank and easily get $300,000 in loan money to purchase index index funds with only $60,000 down without extreme margin call risks. Lack of specific tax shelters. Real estate offers unique benefits like phantom depreciation write-offs, allowing real estate investors to offset real cash earnings against non-cash property losses on paper. Real estate unquestionably outperforms stocks in specific scenarios. Strong cash flow markets. In locations where monthly rent meets or exceeds 1% of the total purchase price, immediate positive cash flow shifts the math heavily in your favor. Treating it as a full business. Investors who strictly screen tenants, systematically manage CapEx, and treat properties as active enterprises can outperform broader stock indices through leverage. House hacking. Buying multi-unit properties like a duplex, living in one unit and renting out the others drastically reduces personal living expenses while building equity. 1031 exchanges. Real estate investors can defer capital gains tax indefinitely by rolling profits directly into larger replacement properties upon sale. Neither asset class is inherently superior. They are simply suited for different goals. Liam assumed real estate was guaranteed passive income without calculating operational friction. Noah trusted that broad market holding would generate long-term wealth without stressing over short-term market swings. The real mistake isn't choosing real estate or choosing index funds. The trap is choosing either strategy based on surface-level claims without accounting for time, stress, hidden expenses, and risk over a 20-year horizon. The next time someone tells you real estate always beats the stock market or stocks are the only logical play, ask them one simple question. Did you calculate all the costs? Because the answer that includes every single expense, labor hour, and compounding dollar is the only calculation that matters.